Hello and welcome to the Weekend Investing Daily Byte of 5th of August. And what a day, a waterfall session for most global markets. India, I think, still escaped the fury of the fall, as I will show you later in this video. So, is it the end of this short-term bull rally? The one that we started from the election day, 4th of June, that bottom, and then coming into 5th of August. So, 2 months of good gains coming through. And is that the end of this particular run? We will discuss this. Please subscribe to the channel if you haven't so far and click on the bell notification. So where is the market headed? The market certainly looks headed down. Uh, the resilience of the market has been phenomenal all these months. This was also showcased very on 4th of June when the market collapsed from 23,000 nearly 300 to 21,300, 1,000 point cut on that day, and which was recovered back within 3 sessions. So we now also have nearly 1,000 point cut from the 25,000 closing 2 days back, and today we have closed at 24,000. So 1,000 points have been released. The technical chart has been disturbed for sure, but there are two big gaps on the upside now above 24, nearly 400 and 24,900. So market needs to make a U-turn and really cover these gaps if we have to sustain above, or it may, I think, in my view, gradually come off, take support at 23,400, and then build a new base. Yeah, maybe giving time to the other markets also to stabilize and consolidate, because right now it is like a falling knife. What is leading is the Japanese market. Japanese market is followed by the US market, and all other markets are following that. So, in some sense, the leadership position right now is dependent upon the Japanese market. As soon as the Japanese market starts to turn, everything else will also turn. Uh, India VIX up by 50%. I mean, that had to happen with that kind of a fall. So the vulnerability of the index is there. Nifty Junior is closing very much within the support line that it had created around 71,000. So while it is down, it's not completely smashed or anything. I mean, we are still very much in the zone of going up. But yes, I mean, it if ever there was a possibility in the last year that the markets could deliver a sort of a short term downtrend, this could be one of that occasion. Mid caps again taking support at the previous bottoms, minus 3.52%. Um, so we've lost maybe a month and a half of gains on mid caps. So some cut, but again, I mean, not really. It's not really a deal breaker as to say that the markets are dead. Um, Small caps, a bigger cut, minus 4%, again losing about 6 weeks of uh, gains there, and getting some support there towards the end, but again dependent on external market for the next cues. Bank Nifty has completely gone off, um, breaking down from the election day high also, and the previous very recent lows as well. So Bank Nifty barely managing to hold above 50,000. So Bank Nifty actually looks weaker than most of the other indices and is leading the market down. Today's heat map is full of heat only. So HDFC Bank minus 2.6%, Reliance 3.4%, State Bank 4.2%, Tata Motors 7%, Maruti 4%. Some of these big names got cut, but the money was moving towards protection, towards defensive stocks. So ITC, Nestle, Britannia, Tata Consumers did not drop. Uh, Asian Paints also did not drop at all. Sun Pharma also virtually 0.5% down only. Rest others were totally smashed. Nifty Next 50 heat map also fully red. You had some deep gashes in Motherson 9%, Bosch 4.5%, Vedanta 4.5%, Adani Green, Adani Power 5 and 6%, LIC 6%, IRFC 7%, REC 5%. So there was no respite at all in this. Of course, stocks that have been running very hard will, at least in the first stage of their correction, will give you a hard correction, and then the relative strength of these stocks versus others may kick in at that point of time. Sectoral trends all red. led by metals minus 4.9% on the metal index, real estate index minus 4.3%, PSU banks 4%, autos 4%, public sector enterprise stocks 3.8, energy stocks 3.8. No place to hide. For the week, real estate has lost 9% already in the last 5 sessions. FMCG, the least hit so far today, minus 0.3%, pharma 1.5%, consumption 1.8%. This is the defensive part of the market. IT was not spared today because I mean US markets have been cracking hard on the technology front, minus 3.3% on IT also. So this has somewhat ruined the last month's picture and is beginning to impact the last 3 month results also. But again, I mean, I would like to say that expecting that the markets will go to the moon is also an unrealistic expectation. And on the flip side, to expect that the market will keep falling is also an unrealistic expectation. When the markets are falling, most people are so afraid that the markets will go to zero, but that is not going to happen. So this is just, I would say, a very good correction right now. Anywhere, in my personal view, after a humongous run like we've had, giving up 10-15% is no big deal. So from that perspective, if you look at history, a 10-15% correction is probably healthy. Of course, it is hindsight very easily now that 10% is good. Nobody likes to even take a 10% hit. That is the part of the behavior that we need to control so that we can stay the course on which we are running. Metals, as you can see, have broken down completely. Metals could not cross the election day high also. So the metals versus other sectors from this perspective are the weaker part of the market, since they are now much lower than where they were a couple of months back. Real estate also is weak versus other sectors in the market, minus 4.3%. And stock markets are a sentiment leader. So as soon as the stock market sentiments will come off the highest notch to maybe normal, you will find that even the physical real estate, the real estate will also, all the buyers will vanish overnight. So this is a ripple effect into the confidence of the economy. Whenever stock markets are down, you will find that people will take a step back. If somebody is going to buy a car tomorrow, they will take a step back. If somebody was going to make a transaction in a real estate, a big transaction which was based on whatever asset they had and they leveraged, and now the assets are suddenly down 5% in a day, they will take a step back. So it is all a chain reaction that starts, and that chain reaction basically reduces the confidence level of the consumer in a very big way. I mean, you yourself, if you were going to make a large discretionary spend tomorrow, with your portfolio getting cut like this today brutally, you probably would maybe pass that item of choice for now. So this is how the mind will play games, and that's how the consumer sentiment goes. I also feel that if this happens for the next day or two, uh, somebody like the US Fed may jump in and do a surprise rate cut, and then catch the bears on the wrong side. So trying to time the market that, okay, I know this market is going to go down and hence I will sell everything here and I'll buy later. Maybe something may happen overnight and you may be buying 10% higher. So don't try all those stunts. If you are a serious long-term investor, don't try to become a trader. If you are a trader, be a trader. I mean, then of course you are trying to be extremely nimble footed, and obviously you would have gotten out of the market even before today if you were a very sharp shooter. But if you are a long term investor, don't try to become a 2 day trader, because that is not your skill, that is not your forte. uh, it may so happen that you may get lucky sometimes, right? So if somebody, let's say, sold on Friday, they could be feeling very lucky that, okay, everything is down 5%. But this is, I mean, that is not a skill. That is just pure luck. So my suggestion, at least based on my experience, and I could be wrong, maybe you have another view, that know what you're doing. If you are a long-term investor, if you are not looking at the market from a day-to-day perspective in terms of going in and coming out, don't worry about what you could have saved by getting out and then getting in, and that will also screw up your long-term or short-term capital gains, etc. Despite this kind of a market, there were stocks that were going up. There were a few stocks I saw which were up circuit also, and Lux Industries was up 9%. So whenever the markets stop to fall, look out for more gains in such stocks, because these stocks are showing you today that there is a huge strength, relative strength in those stocks. So now coming to the end of this short-term bull rally discussion. So what is happening? This is the Nikkei index, Nikkei 225 index. Just less than about couple of weeks back, Nikkei index had made a new all-time high at 42,000 plus, and you can see here that from 42,000 plus, it has collapsed in 3 sessions, mostly in 3 sessions, but yes, some collapse had come early as well by 26% in just 16 sessions. So just imagine 26% uh, on Nifty right now. I mean, that would mean, maybe like 7,000 points, something like that. So just imagine the plight of Japanese investors right now. They have been completely smashed. Their gains from September of last year have been smashed out. But that is how markets are. So know that markets can do all this. To assume that markets will never do this, markets will always go up. This happens in other markets, it won't happen in India market. Don't have all those kind of superior expectations, because anything can happen anywhere, anytime. So you see, you have come to the market to make some excessive returns over the normal, right? And without risk, there is no return. So you are taking on some risk knowingly or unknowingly. That is why you are getting those returns. So you will need to take those risks. Uh, so this is the long-term view. So somebody who bought the Japanese market in 1990 and who was feeling very, very happy a couple of months back that finally, after a wait of 30 years, um, my price has come back, is now disappointed again, because they're now again back in 20-25% kind of drawdown. But that's how the Japanese market has been. In Japan, if somebody had invested in gold along with equities, they would not have had any issues. So now let's go into what is carry trade, because you would have heard about this by now, that it is all happening due to the Japanese carry trade. So carry trade is nothing but a buying stock, or let's say there is a investor. Let's say I'm the investor, and I want to borrow at low cost and invest in higher returns, right? That is normally what one would do. So if I were to get a loan at 2% and I could invest that money which generates 10%, I would like to do that. Just eat that carry. So what was happening was, because Japan was always a low interest rate economy since the 1990s. What was happening was, a lot of hedge funds institutions were borrowing from Japan at near zero rates. Uh, and investing the world over, in technology stocks, in bonds, so on and so forth, because the returns there were very, very impressive. And you borrowed at 0 or 1, and you're getting 10 or 20 there. You are pocketing the difference. It will sound so amazing, right? That you have not spent a single penny from your pocket, and you borrow at 1 and you invest at 10, and that's exactly what the banks do. They borrow from you from your FD at 6%, and give it to the industrialists at 16%, or give you loan against shares at 16% and eat that difference. So this is exactly how money gets made without too much of your own capital. So now the only caveat here is that if you're doing this, uh, the currency from where you borrowed, so the yen that you borrowed should not appreciate against the currency where you're investing. So if you're borrowing in yen, investing in dollar, then if yen starts to move strongly versus the dollar, then that margin will get collapsed. So it is, so dollar would potentially continue to appreciate against the yen. That was the trade that was going on, and now suddenly the USD yen has gone from 160 to 142. So everybody is scampering to cover their transaction. So by covering the transaction is to reverse the transaction. So what you bought, whether they were stocks or bonds, you want to sell that and repay the yen loan. And this has come around because yen interest rates were rising now, and USD interest rates were falling. The yields were going in the opposite direction, and hence there was a risk to all this. And this is a huge market of carry trade. Some trillions of dollars of carry trade happens there. So the risk of these carry trades is that the economic winds can change, and people could, start sending money the other way. There could be political changes, interest rate changes, speculation on prospects of currency volatility. So all that can impact the carry trade, and this is the USD JPY. you can see that suddenly there was a 12% fall in the USD JPY because of the rate hike by Bank of Japan by 0.25% and the specter of rate cuts by US Fed. So the US yields are already coming off. So the gap or the differential actually changed very, very dramatically suddenly. And that is causing a lot of stress in the markets. So how much of this is happening? So nobody really knows, but there is a guess of, a few trillions, 4 or 5 trillion also, and there's a somebody saying 20 trillions of asset, but everything need not unwind. It's only the weak players or those who get edgy will unwind. Just like in our markets, if a stock is falling, everybody doesn't come and sell it. Only those who may be designing their strategies to get out at a particular event, or who are weak hands or who can't take the margin loss, they will be exiting. So the other impact, of course, can be that Indian businesses also borrow a lot from Japan. For instance, the bullet train project, I think, is also funded by Japanese money. So all that gets impacted whenever the base currency is rising and the interest rates are rising. So a lot of FPIs also are there who have possibly borrowed in yen and invested in the India market. There may be some carry trade unwind that can happen there as well. But given today's reaction to all this, I still feel confident that we don't have too much to go on the downside. But then again, this could be just a biased speculation. So you can see this here that Indian rupee JPY also has collapsed dramatically. In fact, a friend of mine was visiting Japan just 2 weeks back, and he mentioned to me, that it's a fantastic time to go to Japan because everything is so cheap for Indians there, and that has suddenly changed, almost 20% within a matter of days, if not weeks. So the currency moves actually impacts a lot of trade, a lot of tourism, a lot of positioning, and I think the resulting sort of you can say readjustments also will not take too much time. It's not like this unwinding will continue for days together. It's whatever has to happen will happen very, very quickly, and then there may be a long period of time for consolidation that may be there. So that may have caused is some panic in the market, and it is natural to panic, especially if you are let's say the first time or second time witnessing some falls. So just like maybe when you are on a swing, maybe the first time you have a high swing, you may feel vulnerable. The next time you will try to maybe enjoy it, because if you have decided that you're going to stay in the market, and there's no point to panic, right? No point losing your sleep over it if you are not going to do anything about it. If you are sort of a trader or something shorter term and you could have cut your position, then of course if you're not cutting your position, then you are doing extreme damage to yourself. But if you're a long-term investor and your strategy will determine whether you should stay in, stay out, and don't worry about it, because anyways you were not supposed to do anything at this point of time. So see what is right for you, how what kind of investor you are, and and go along and don't panic. I mean, panic doesn't help anybody actually. So thank you so much for watching, and let me know your thoughts. I'll be waiting to read your comments. Thanks. Bye.